Welcome to the Kent Lapp Podcast.
How's business? I have to think this is a challenging time.
Tell you what, Kent, the mortgage business is quite a riddle right now. Everybody came out of the woodwork looking for what the government was calling 0% interest rates.
Yeah.
And that drove scores and scores of people into the market looking to refinance.
Because they're hearing on the news and whatnot? And,
Yeah.
Okay.
Because you hear on the news that the Fed reduces interest rates to zero.
Right.
People hear that and they think mortgage rates must be like free.
Okay.
And it's just not the case. Mortgage rates, while they're influenced by what the Fed does with interest rates, they're not tied to that. They're tied to a number of different things, one of which being mortgage-backed securities. They're also tied to supply and demand. And when everybody and their brother decides that they want to get a refinance done, demand goes way up. And our industry has limited capacity. Every application needs somebody to take it, originate the loan. We need to process those loans. We need to close those loans. We need to turn around and sell those loans. We need to have the capital in the marketplace to be able to fund all of those loans. And so business has been just one of those crazy times where there's an abundance of opportunity, and then there are all of these other elements that regulate capacity. So you can't do it all at once, and so it's going to be a nice, long grind through trying to get everybody in a mortgage that they're happy with.
When did you see people coming to you hearing, 0% interest, let's go ahead and refinance? Was this February? Was this January?
It was February. I mean, rates were pretty good, pretty low going into February. And towards the end of February, the sky just fell out. And people from all over came looking for refinance.
Came calling because they were after that 0% interest.
Yeah.
Are you giving anyone 0% interest?
It
I mean, you
exist.
can't, right? Because you're not making any money at that point. That's impossible.
It costs a bank about 3% just to put a loan on the books and make a profit. And so by the time you pay for the person to originate the loans and all of the process associated with putting it on the books, keeping some level of profit, because we are a for-profit business. And so there's typically a delta between the cost that you get your money at. There's typically a delta of about 3% between what you can buy the money at and what you can sell the money at. Not always exactly 3%, but that's a good general rule of thumb.
So if you're getting the money, am I understanding this correct? If you're getting the money, say for 0%, I don't know if that's possible, but then you're going to want to go 3% on top of whatever you're getting the money for, and that's how you can make money.
Yeah, so you make money off the spread. So you might buy money at 1% to 2% and turn around and sell it somewhere around 4%.
Okay,
but
gotcha.
there are rates today under 3%, which are 15 short-term duration mortgages.
Well, that's what I was going to ask. When you said, generally speaking, banks are not making money under 3%, but there are some out there that are sub 3%, right? For particular borrowers.
There are. And that stream of income comes over time in the way of the servicing premiums that you get. So every time you make a mortgage payment, you're paying several different people. So if you have, say, a 4% mortgage, let's call it a conventional Fannie Mae-based mortgage, about 3% of that was going to the underlying holder of the note, the security, the mortgage-backed security. Call it another 25 to 40 basis points is going to the person who's collecting your payments every month, the servicer. They collect your payments, they forward the money, the interest onto the bondholder, they retain money for your escrows, things like taxes and insurance. And then there are guarantee fees that you pay to Fannie Mae to guarantee to the underlying bondholder that you're going to make your payment. So Fannie Mae is really collecting insurance premiums.
I was just going to say, almost like an insurance?
Yeah, they insure the bondholder on default from the people who own the mortgages underlying that security. And so your 4% payment goes to a lot of different players.
Yes. Now, so I was curious kind of how the mortgage industry works, which we're getting into. And then I was also curious kind of what Churchill Mortgage, kind of what your role is on that kind of that trajectory, or those, you're one of several parties, obviously. Do you guys, what does Churchill Mortgage do here? Are you guys collecting these loans, or are you making the mortgage and then kind of moving on altogether?
We do a couple of different things. So the first thing we do is we work with people like you and all of the other folks that need to get a mortgage to either purchase a home or want to refinance the mortgage they have. And so we're working with you. We're getting you in the right loan. We're one of the only, if not the only, mortgage company that I know that believes in trying to get you to a place of what we call the real American dream, which is debt-free home ownership. We're a mortgage company that's trying to get you to stop ever having to pay your mortgage by structuring things in a way that allow you to get to a debt-free lifestyle faster.
That's not common in the mortgage industry?
Not common in the mortgage industry.
Is that why you're a good fit with Dave Ramsey's organization?
That's why we're a very good fit with Dave Ramsey's organization. So after we close all of these loans, and we fund the loans ourselves. And so we
You do?
Mm-hmm. And so once we've gotten once we close the loan and we have we basically pool together a group of common loans. And so if your loan might be $300,000, we pool together several $1 million worth of those types of loans, and we turn around and we sell them to Fannie Mae.
Okay.
And then we sell the underlying note to Fannie Mae. We retain the servicing and make sure that you're making payments on your mortgage. And so that's our kind of role in all of this. We make the mortgage, we pool them up with other mortgages, we sell those to Fannie Mae, who in turn puts them out into Wall Street in the form of mortgage-backed securities. We retain the servicing rights, and then we send you notices each month that your payment is due. We collect that payment and manage your escrows and make sure your taxes and insurance are paid year after year after year while we're holding those servicing rights.
And do you service the loans on the notes on all of the loans you make?
Not all of them.
Okay.
Only select ones. So
yeah?
Government loans, we'll sell the servicing on those. And some conventional loans, jumbo loans, we don't retain. So we sell those as whole loan packages.
Interesting. And the jumbo loan it's a mortgage that's over $450K, right?
It depends on where you are in the country.
Okay. Yeah. Gotcha. So, okay.
But higher loans that don't fit the underlying credit box of Fannie Mae or Freddie Mac.
Okay. Gotcha.
So most of those go to large banks that keep them on their portfolios.
So you're selling nearly all of the average home that's going to use you guys for a mortgage is getting sold to Fannie Mae.
Yeah.
Oh, okay, gotcha. I was actually thinking there was one more party in there, and then Fannie Mae just made sure if they ever had a big loss that they'd cover it. But you're selling it right to Fannie Mae.
We sell it to Fannie.
Okay.
And there's an insurance premium on that transaction that they get for their guarantee to the underlying bondholder. The bondholders are the people on Wall Street that invest in mortgage-backed securities.
Okay.
And it's a funny thing with interest rates. Let's go back to where we started.
Yeah.
The more and more demand there is for the underlying bond, the higher the interest rates will go. Okay? And the stock market and the bond market work in opposite directions of each other. So if the stock market's doing really good, if the economy's booming, oftentimes mortgage rates will go up.
Okay.
If the economy's doing poorly and having bad news, oftentimes that will drive mortgage rates down.
Yes.
And so it's just a really interesting dynamic as the overall economy relates to mortgage rates.
Yeah. Now, how much discretion does Churchill Mortgage set the interest rate? You can make it whatever you want within parameters. I'm sure there's laws about price gouging or whatever, but whether you're going to give me a mortgage at 3% or 4% or 6% is largely your call.
It is.
Okay, gotcha.
Yeah. And we generally will band our rates around quantitative elements of the borrower and the location. So your credit score, for example, may drive your interest rate up or down, depending if it's a great credit score or a poor credit score.
Mm-hmm.
The amount of money you're putting down
Mm-hmm.
might generate a different interest rate if you're putting 30% down in your mortgage versus 3% down on your
Yes.
mortgage. So there's all of these risk-based pricing
Yes.
that goes into kind of how we set mortgage rates.
I see. Does Dave still recommend? Ooh, shoot. Now is it 15% down, 15-year fixed rate mortgage with the payments no more than 25% of your income? Is that
You're
roughly
really
accurate?
close.
Okay.
15-year fixed mortgage. He prefers 20% down, so you have no mortgage insurance.
Oh, okay.
All right, and no more than 25% of your income.
Okay, 15-year fixed rate.
Yep.
Is that what you guys recommend too, or?
We recommend that on just about every loan. However, most customers don't have the ability to do that.
Okay.
And so our job is not to be police for Dave Ramsey. It's to
Right.
reinforce what he teaches and
Mhm.
why that's a good thing. Because it does help you achieve debt-free home ownership faster.
I see.
But our job beyond that is to help you get on the right path
Yeah.
towards that.
Mhm.
Your starting point might be something very differently.
Yeah.
Right now, you just might not have the down payment to make, or you might not have the ability to fit into a 15-year fixed mortgage and might need to go 30-year fixed. Whatever your unique situation is, our job is to help you get into the home, the right home, not overpay for that home, not overborrow for that home, but the right home, and then get you on a path towards debt-free home ownership, which part of that path is getting you to that 15-year fixed mortgage
I see.
that you can continue to afford and pay down in an accelerated manner. And
Yeah.
we've helped scores of people do that.
Yeah, that's wonderful. So if you are, can you share what your average buyer is like? Is that is that confidential information as far as like I don't know, net worth or income or the average mortgage amount that you are funding?
I can share with you a few things. The average mortgage, the average loan amount we're funding right now is around $250,000.
Okay.
The average FICO score, the average credit score is over 740, which is better than the national average. It's a really good credit score. That doesn't mean we don't work with people with much lower credit scores than that. We do. It just happens that Dave's clientele that typically will call us about a mortgage have been following his principles for a while and have started to create some good financial habits. And so we do get the benefit of his teaching to his listeners.
Interesting.
And only about 35% of what we do comes off of our advertising and our work with Dave. The rest of it comes through your normal, traditional build relationships with realtors and financial planners and do our own marketing. And that's the majority of what we do. But we do benefit by being able to offer some financial advice consistent with how Dave teaches and build that into just our practice.